On one side, you have Bank of America with a jaw-dropping forecast of $309 per ounce. On the other, TD Securities, one of the largest financial institutions in North America, came into this year predicting silver would fall back to $49. Two of the world's biggest banks, looking at the same data, arriving at conclusions that are 600% apart from each other. So today, we are going to do something that most financial channels are afraid to do. We are going to lay out both sides of this argument, fairly and completely, using the freshest data available as of February 18th, 2026. By the end of this video, you will understand exactly what is driving each case, and you will be in a position to make your own informed judgment about where this metal is headed. Let's start with the facts as they stand right now, because the current situation is genuinely unlike anything we have seen before. Silver is currently trading at approximately $72.61 per ounce as of today. That number alone would have seemed absolutely extraordinary just 14 months ago, when silver was sitting at around $30 per ounce at the start of 2025. That means this metal has more than doubled, and then some, in barely over a year. But here's the thing that makes today's price especially fascinating. It is not the high, not even close. Silver hit an all-time record of $121.63 per ounce on January 29, 2026, just 3 weeks ago. And then, in one of the most violent corrections in precious metals history, it crashed. It fell more than 30% from that peak in a matter of days. And right now, as we record this video, it sits at $72, which means we are roughly 40% below the all-time high that was set less than a month ago. So the very first thing you need to understand before we get into the bull and bear cases is this. Silver is not a calm, stable, predictable market right now. It is a market that surged 147% in 2025, broke records no one thought possible, and then gave back a significant chunk of those gains almost overnight. And the reasons behind both the rally and the crash are crucial to understanding where the metal goes from here. Why did silver crash from $121? There are two key reasons. First, the CME Group, the exchange that runs U.S. futures markets, raised margin requirements on silver contracts from 11% to 15%. For the highly leveraged speculative traders who had piled into this market, that change was devastating. It forced them to either inject massive amounts of new capital or immediately close their positions. And since most of them chose to close, you had a cascade of forced selling that turned a normal market correction into a full-on crash. Second, U.S. Treasury Secretary Scott Bessent pointed fingers directly at Chinese traders, describing the January rally as a speculative blow-off driven largely by momentum-chasing activity in China. Whether you agree with that framing or not, there is no question that Chinese participation, and then Chinese withdrawal, played a huge role in silver's wild price action. Now add to this one more important context point. China's New Year holiday runs from February 16th through the 23rd. Right now, as we speak, Chinese markets are quiet. Trading volumes from Asia are reduced, which means the next week could be particularly volatile for silver, as thin liquidity tends to amplify every move in both directions. The bull case, why silver could reach $309. Now let's make the bull case, and let me be honest with you up front. This is a genuinely compelling argument backed by structural data that is hard to dismiss. The most important foundational fact for the silver bulls is the supply deficit. The Silver Institute, which is the primary research body tracking global silver flows, has confirmed that we are now in our 5th consecutive year of silver supply deficit. That means for 5 straight years, the world has consumed more silver than it has produced. The cumulative shortfall since 2021 has exceeded 900 million ounces, which, to put that in perspective, is roughly equal to an entire year of global mine production. That silver is gone, it has been consumed, it has been used in solar panels, electric vehicles, electronics, and industrial applications. It cannot simply be brought back onto the market, and the structural reason behind that deficit is not going away. In fact, it is accelerating. The photovoltaic industry alone, that is the solar panel sector, now consumes over 230 million ounces of silver every single year. Every solar panel requires silver for its electrical conductivity. As the world continues to build out renewable energy infrastructure at a record pace, that demand only grows. Electric vehicles each use between 25 and 50 grams of silver in their electrical systems and sensors. With EV adoption continuing to climb globally, that adds another enormous and growing demand source. But here is what most people have not yet fully absorbed. Artificial intelligence and data centers have now emerged as a completely new demand vector for silver. AI infrastructure requires silver in high-efficiency electrical components, precision contacts, and thermal management systems. The build-out of AI data centers globally is happening at an almost incomprehensible speed, and every server rack, every high-performance processor, every cooling system uses silver. This is brand new demand that was not even part of silver's demand story 3 years ago. Gold Silver's lead analyst, Alan Hibbard, one of the most respected voices in the precious metals world, has publicly stated that silver has still not fully priced in the structural deficits and explosive industrial demand building beneath the surface. He expects silver to trade above $100 in 2026. Ned Naylor Leyland of Jupiter Asset Management told CNBC that reaching the $100 milestone was, in his words, absolutely possible this year based on market fundamentals. UBS, the Swiss banking giant, has actually forecast that silver will return to the $100 threshold as early as next month, in March, before potentially pulling back to around $85 by year-end. And then there is the technical case. Silver's 50-year cup and handle pattern, one of the most powerful technical formations in charting, broke out decisively in 2025. FX Empire analysts describe this upward shift as the most powerful bullish reversal in history in technical terms. When you have a 50-year formation complete, the measured target is enormous. FX Empire's technical analysis, built on measuring the depth of the cup from the breakout level of around $30, points to a potential target range of $250 to $300. That is precisely where Bank of America's bull scenario of $309 comes from. It is the measured move of the completed technical pattern. The gold to silver ratio is another powerful argument for the bulls. Right now, the ratio is tracking at its tightest levels since the early 1980s, but historically the ratio averages around 55 to 67 over the long run, and in silver bull markets it has compressed dramatically further. Some analysts from Scottsdale Bullion note that as an anchor point for the bull case, if the gold to silver ratio occupies the 40 to 50 mark, the bottom end of its 30-year range, for an extended period, that implies silver prices of around $160 per ounce by the fourth quarter of 2026. With gold trading near $5,000 and climbing, a normalized ratio alone would put silver well into triple-digit territory. There is also the macro tailwind. The Federal Reserve has already cut rates 3 times, in September, October, and December of 2025, and markets are currently pricing in approximately 60 basis points of additional easing by year-end 2026. Lower real interest rates are historically one of the most powerful bullish forces for precious metals. When yields fall and real rates become negative, the opportunity cost of holding silver drops to zero, and institutional money flows into hard assets. We are seeing exactly that dynamic now, with ETF inflows turning positive after nearly 2 years of net outflows. China is another wild card that could turbocharge the bull case. China controls between 60 and 70% of the global refined silver supply, yet in early 2026, China actually imposed export restrictions and new licensing requirements on silver. That single policy decision caused an immediate supply shock that sent premiums in China and India surging to $8 to $10 above spot price. If China tightens those restrictions further, or if geopolitical tensions between the US and China escalate, the supply side of the equation could tighten dramatically and rapidly. Mike Maloney of Gold Silver has made a point worth noting. The US government once held a massive strategic silver stockpile. That stockpile is now completely gone. In an era defined by solar panels, semiconductors, batteries, defense systems, and AI infrastructure, silver is not just an investment metal. It has become a critical input for national technological and security interests. The US government has officially designated silver as a critical mineral. When nations begin competing for a finite resource that is essential for their technological and military capabilities, prices can move in ways that defy conventional modeling. And finally, JP Morgan Global Research, one of the most credible financial institutions on the planet, projects silver averaging $81 per ounce in 2026, with a high of $85 in the fourth quarter. Citigroup revised its silver forecast upward to $150 within 3 months at one point in January, citing continued strong buying momentum in China. The Oregon Group's senior analyst Anthony Malowski stated publicly that while $150 is aggressive, the combination of constrained supply, industrial demand growth, and macroeconomic uncertainty makes it worth serious consideration. The bear case. Why silver could fall to $49. Now let's make the bear case. And I want to be equally fair here, because the bears have real arguments too, and ignoring them would be doing you a disservice. TD Securities, the Canadian investment bank, came into 2026 with one of the most bearish silver calls on Wall Street. Their original forecast was for silver to retreat to the mid-$40 range by mid-year 2026. They also introduced a concept they called the silver flood, essentially the argument that the London Bullion Market Association's free-floating silver inventory had seen a record replenishment, with over 212 million ounces of silver bars flowing into London vaults. According to TD Securities, that is enough to cover nearly 2 years of the global supply deficit. In other words, the bears argue that the physical tightness narrative, the idea that silver was genuinely running out, was overstated, and that inventory replenishment could temporarily remove the urgency for prices to keep climbing. Goldman Sachs and Citigroup have both urged caution on silver compared to gold, specifically because silver lacks the central bank buying support that has been driving gold higher. Central banks around the world have been accumulating gold reserves at record rates, providing a deep, institutionally backed demand floor that silver simply does not have. Silver's industrial nature means it is more economically sensitive. If global manufacturing slows, if solar installations miss growth targets, or if EV adoption plateaus, demand can disappoint. Goldman Sachs analysts Lena Thomas and Don Stuyven explicitly noted their concern about supply constraints in the London market, while being more cautious about silver's outlook relative to gold. There is also the demand destruction argument. UBS made a particularly important observation. With more than 50% of silver demand linked to industrial applications, prices above a certain level, and $100 is the threshold many analysts cite, will eventually cause industrial users to seek substitutes, optimize usage, or reduce consumption. Solar panel manufacturers, for example, have already been working on using less silver per panel. At very high silver prices, those thrifting efforts accelerate dramatically. The bears argue that silver above $80 or $90 starts to destroy its own demand base. From a technical perspective, Jim Wyckoff, senior technical analyst at Kitco, has described the current silver market as being in a very mature bull market, and he warns that the cyclical nature of commodities means boom is followed by bust. Elliott Wave analyst Avi Gilbert has gone even further, predicting that 2026 could actually mark the end of this long-term uptrend cycle and the beginning of a multi-year bear market. Even though Gilbert maintains a short-term target of $75 to $80, he believes that could represent a final blow-off top before a prolonged decline. There are also demand-side cracks emerging in specific segments. India, the world's largest market for silver jewelry and silverware, saw its silver imports decline by 14% year over year through October 2025. When the world's biggest consumer of silver jewelry starts pulling back, it matters. BMO Capital Markets is also projecting that some industrial demand segments could see year-over-year declines in 2026. And we cannot ignore what happened in late January. The crash from $121 to the 70s was a clear warning sign that speculative excess was built into the price. When you have leveraged traders being forced out by margin hikes, you are looking at a price that was not fully supported by real physical demand, at least not at those extreme levels. The bears would argue that silver found its speculative ceiling and that the current price of $72, while elevated historically, is actually a more realistic reflection of underlying fundamental value. Finally, if the Federal Reserve changes course, particularly if Kevin Warsh, who is widely expected to replace Jerome Powell as Fed chair, takes a more hawkish stance and raises real interest rates, the macro tailwinds for silver could reverse quickly. Higher real yields make the opportunity cost of holding silver more expensive. A stronger dollar, which is the typical result of tighter monetary policy, also makes silver more expensive in other currencies, reducing global demand. The bear case, at its core, is the scenario where macro policy tightens, industrial demand disappoints, and speculative money that flooded into silver in 2025 decides to find a better home. The institutional scorecard: what the banks are saying. Let's quickly run through the full range of institutional forecasts so you can see exactly where the smart money is positioning. Bank of America. Bull case $309, average around $56. TD Securities. Average annual price target $65.50 with a 2026 high of $118. JP Morgan. Average $81, high of $85 in Q4. UBS. Return to $100 in March, ending the year around $85. Citigroup. At peak bullishness, called for $150 within 3 months. HSBC, range of $58 to $88. BMO Capital, $55. CME Silver Futures, year-end average priced near $91.23. Gold Silver lead analyst Alan Hibbard, above $100 in 2026. Keith Neumeyer, CEO of First Majestic Silver, $100. Larry Leopard, $75 by mid-year. Here's what is remarkable about that list. Even the most conservative institutional forecasts, BMO at 55, Bank of America's base at 56, represent silver that is still significantly elevated compared to where it was 18 months ago. The bears are not predicting a collapse back to $30. They are predicting a correction within what everyone acknowledges is a structural bull market. And the most bullish forecasts are in territory that would have seemed like fantasy just a year ago. So with all of that laid out, let's talk about what actually happens next. And to do that, we need to look at the specific catalysts that will determine which direction silver takes from its current level of $72. This week is absolutely critical. Today, February 18th, the Federal Reserve releases its FOMC meeting minutes. This document will give markets their clearest read yet on how policymakers are thinking about the pace of rate cuts in 2026. Any hint of faster easing will be bullish for silver. Any suggestion that the Fed is pausing or reconsidering will be bearish. Tomorrow, Thursday, we get U.S. initial jobless claims, and on Friday, U.S. fourth quarter GDP data and the February manufacturing and services PMI readings come out. If those numbers confirm the weakness we are already seeing, December retail sales stalled, the GDP control group actually fell 0.1%, then the case for Fed easing strengthens, and silver gets a tailwind. Beyond this week, the next major catalyst is Chinese demand returning after the New Year holiday on February 23rd. If Chinese physical buyers come back aggressively, you could see a sharp recovery toward $85 or $90. If they stay on the sidelines, the current price could drift lower toward $65 to $70. The medium-term picture for the rest of 2026 really comes down to three scenarios. In the bullish scenario, the Fed delivers 60 or more basis points of rate cuts, Chinese demand reignites, the industrial deficit continues to deepen, and ETF inflows accelerate. In that world, silver tests $100 again, potentially breaking through and holding above it. The cup and handle measured move target of $250 to $300 becomes a longer-term possibility, though most professional analysts think that is a 2027 or 2028 story rather than 2026. In the base case scenario, silver trades in a range of $70 to $85 for most of the year, experiencing the two-way price action that replaces the explosive one-directional gains of 2025. Industrial demand holds up, the supply deficit continues, but narrows slightly, and the market consolidates after its historic run. This is probably the most likely scenario, based on the weight of evidence, and is consistent with JP Morgan's forecast. In the bearish scenario, real yields rise, the dollar strengthens as Warsh takes over the Fed with a tighter stance, Chinese demand disappoints, and industrial users begin thrifting at scale. In that world, silver could test TD Securities' mid-$40 to $50 range. It would be painful for recent buyers, but would not change the long-term structural bull story. There is one wildcard that deserves special mention, the LBMA free float situation. As TD Securities flagged, only about 155 million ounces of silver in the London vaults are actually freely available for trading. The rest is owned by ETFs and private entities. At the pace of ETF demand we have seen recently, that free float could come under severe pressure. If headlines begin to emerge about genuine settlement difficulties or shortages at the LBMA, it could trigger an explosive, almost uncontrollable rally. That is the scenario that Mike Maloney and other hard money advocates have been warning about for years. It has not happened yet, but the conditions for it are closer to being in place now than they have ever been. Here is what I honestly believe, based on all the data we have covered today. Silver is in a genuine, structural, multi-year bull market. The foundation of that bull market, chronic supply deficits, irreplaceable industrial demand from clean energy and AI, a Fed easing cycle, and a weakening dollar, is real and is not going away. The bears make valid points about short-term overextension and demand destruction at extreme prices, but they are largely fighting the tide of structural forces that have been building for years. My realistic expectation for 2026 is that silver spends most of the year in the $70 to $100 range, experiencing significant volatility in both directions. I think there is a better-than-even chance silver tests $100 again before year-end. I think the $309 Bank of America bull case is a longer-term scenario that requires everything to go right, including geopolitical escalation and a complete LBMA free float crisis. It is possible, but it is not the base case. And I think the $49 TD Securities bear case has already been largely invalidated by the market. That prediction was made before China's export restrictions, before the LBMA inventory data became clear, and before the current macro setup crystallized. The more important point for you as an investor or observer is this. The range of outcomes for silver in 2026 is wider than almost any other asset class on the planet. That means both the opportunity and the risk are extraordinary. This is not a market for investors who need stability or who cannot stomach a 40% drawdown. We literally just watched one happen in 3 weeks. But for those who understand the structural story, who have a multi-year time horizon, and who can handle the volatility, silver remains one of the most compelling asymmetric opportunities in the market today. The fact that two of the world's biggest financial institutions can disagree by 600%, $49 versus $309, tells you everything you need to know about the uncertainty in this market right now. Nobody truly knows where silver goes from here. What we do know is that the fundamental story has never been stronger. The technical breakout has been confirmed, and the macro environment of falling real yields and dollar weakness historically favors hard assets. The bulls have the stronger structural argument. But the bears are right that the road will be violent and unpredictable along the way. That is the silver market in 2026. Watch those FOMC minutes today. Watch what happens when China comes back next week. And keep a close eye on LBMA free float data. That could be the single most important number in the entire precious metals market for the rest of this year.
If you found this analysis valuable, please hit the like button and subscribe. It genuinely helps us reach more people with independent market analysis. Drop your silver price target for end of 2026 in the comments. I read every single one. And if you want a deeper dive into the gold to silver ratio or the LBMA free float situation, let me know and we will cover it in an upcoming video. As always, this is not financial advice. Do your own research and consult a professional before making any investment decisions. I'll see you in the next one.